Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The government babus and the netas also often speak about the robust health of public sector banks in India, particularly citing their low NPAs, surplus funds position, and their capital adequacy ratios being much above the minimum mandatory levels which are set by the Reserve Bank as the banking regulator. These specious and misleading claims hide the fact that if the government-owned banks look healthy today, it's not because there has been any sharp pickup in the loan and credit growth of theirs, or that there has been an improvement in their performance and profitability. These banks look healthy today only because, as the owner of these banks, the government has pumped in over rupees 3 lakh crores in the past 3 years to recapitalize them and to shore up their capital above the minimum mandatory threshold to be in the business of banking. To us, it's a mere false dawn, which we have often seen on several occasions in the past when the public sector banks lost their capital due to their reckless and corrupt lending, only to be recapitalized by the government again so as to restart their dubious operations all over again and again. Such pumping in of additional capital by the government to rescue public sector banks has often happened in the past after each round of several years of their politically patronized, corrupt and collusive lending, which erodes their capital. Huge losses take place by way of bad loans, and then these bankrupt banks require recapitalization again, which the government readily does. The current so-called healthy position of the government-owned banks could thus prove to be another temporary and passing phenomena before their balance sheets are overwhelmed and subsumed by bad loan losses again, which is likely and could be round the corner, because to us there are still many segments of bad loans which remain hidden and have not yet been reported. The reality is that the state of the nation's economy reflects directly on the balance sheets of the lending banks. Generally speaking, lenders show a subdued performance and profitability in a slowing economy, where the private sector is unwilling to invest in new projects, where unemployment is raging untamed, where the means of livelihood have eroded, and where the banks copiously lend to the stressed and desperate individuals who need to borrow to survive, and they do not really get genuine, good, credible corporate borrowers. This explains the rapid growth rate of the retail loan segment today in India and the lurking and unrecognized NPAs in these loans, which will soon hit the public sector bank balance sheets again. The RBI itself is on record saying that there is every likelihood of a massive build-up of bank NPAs by October, November this year, with defaults in the restructured and moratorium loans accounts looking very imminent because of no worthwhile improvement in the overall economy and no improvement in the business and cash flow of these moratorium and restructured loan accounts. This is going to be further aggravated by the ensuing repo rate increases this year as the Reserve Bank eagerly seeks to combat a rise in inflation. You're going to see interest rate hikes on more occasions in the coming quarters. This reality about government-owned banks, which is public sector banks, which is PSBs, is apparent in the recent March quarter and financial year 2022 annual performance figures announced by the State Bank of India. The nation's largest bank, the nation's largest lender, reported record ever profits, which not surprisingly failed to enthuse or impress the markets, and the SBI share price fell by 3.8% upon the announcement of these results, tanking the BankX index also. So what was SBI's record performance and why did it fail to impress the markets? State Bank reported the highest ever quarterly profits of 9,114 crores, which on a year-on-year basis is an increase of 41%. Its profits of 31,676 crores for financial year 2022 were the highest ever, recording a year-on-year growth of 55%. SBI's huge profits are mainly because of a sharp decline in its loan loss provisions and an improvement in its net interest margin. Its provisioning for bad loans in March 2022 was 11,051 crore rupees as against 7,237 crore rupees in March 21, and so was the net interest margin much better at 31,198 crores in March 2022 as against 27,067 crores in March 21. The State Bank chairman gloated over the record SBI performance and said that SBI has created sufficient contingency provisions against its restructured loans in order to insulate its balance sheet from any future shocks, trying to say that the bank is well positioned. He says that the bank is seeing a revival in its corporate credit demand. He said that the environment will be conducive for growth in corporate credit in the coming days. He further said that an upward revision in the repo rate will be positive for State Bank of India. That's because while lending rates get reset and repriced at once upon the very announcement of a repo rate hike, there is, however, a time lag in the increase in the fixed deposit rates, thus giving an improved net interest margin profitability to the bank. As we said, the market was certainly not impressed by State Bank's best ever performance, and nor was it impressed by its chairman's words. It is what the Financial Express calls a case of only modest earnings and missed estimates, with SBI's quarterly profits of 9,114 crores being much lower than the analyst estimate of 10,180 crores, which was set by Bloomberg. The hidden negatives in State Bank's record profits are worth looking at. The first one, credit demand growth from the industry has been far below expectations, with no impressive uptake in corporate loans by State Bank of India. Loans to individuals recorded a growth rate of 15%, with State Bank's retail loans crossing 10 lakh crores in aggregate and thus constituting 35% of its loan book of about 28 lakh crores. India's household sector is overstressed, and that is where the maximum credit growth of SBI appears to be, which certainly is not good for the lender. The second, the Indian MSME sector is also in a mess, and State Bank's restructured loans to this sector stand at about 30,000 crore rupees, foretelling the potential NPA build-up. The third, by the State Bank chairman's own admission, its credit growth is still being led by the retail sector, and he hopes that the government's infra capex push will restart the private capex cycle to improve its loan growth prospects, which has not happened so far. The fourth, there was just a marginal sequential improvement in State Bank's net interest margin between February to March 2022. SBI sits on abundant liquidity today with not many borrowers or takers for it, despite interest rates having been low. There is no revival of credit demand from corporates, and the SBI chairman has himself often pointed out that abundant liquidity is leading to the mispricing of risk among the lenders, increasing the chances, the probability of loans going bad. And to us, State Bank would be no exception to this kind of mispricing of risk, as he says. The real story of the state of public sector banks is not evident on the surface of the performance numbers of State Bank of India, and also not in the recently released modest and mixed performance numbers in the case of Bank of Baroda, Union Bank of India, and Canara Bank and others. To us, a far more realistic picture is revealed by the performance of another large public sector bank, which is Punjab National Bank. The bank reported a poor set of earnings for financial year 2022, with its net profits down by 65% on a year-on-year basis because of a 35% increase in its credit costs. Its default slippages jumped sharply to about 6% annualized, outpacing its recoveries, showing that a massive build-up of NPAs is in the offing. Punjab National Bank's net interest margin went up by just 5% on a year-on-year basis, and all this happens when the repo rate was a lowly 4% throughout financial year 2022, to which these figures pertain to. These figures of Punjab National Bank mirror the larger economy, which remains in a stressed slowdown. This is further confirmed by yet another report which says that NBFCs are reporting startling lapses in their credit portfolios, which have come to light amid the ongoing withdrawal of the COVID-era liquidity measures which were introduced to counter a pandemic-induced slowdown. These NBFCs are making additional provisions to cover losses arising out of vehicle loans, housing loans, and personal loans, which are segments where State Bank incidentally has huge exposures, growing exposures. Another report says that the MSME sector is suffering immensely because of the power crisis, and therefore closures and loan defaults are imminent in this segment all over again. The fact is that inflation and the repo rate rise are slowing India's growth rate further and are making borrowing unviable for borrowers. There were no takers for loans when interest rates were low, and they are not bound to be there when interest rates are going up and growth is slowing down. Moreover, with the effect of loans restructuring and moratorium withering away and growth being amiss for the MSME and the household sector in particular, NPAs are bound to shoot up in the coming quarters. That's the real story, which the State Bank figures don't speak about, and that's why its performance has disappointed the markets and disappointed us also. It may be record profits at the moment, but all the good health being shown is temporary. Wait for the next backlash to come by way of massive build-up of NPAs in the system. This is Akhilesh Bhargava signing off till we meet again. Namaskar.